The 2008 financial crisis is usually remembered through one image: employees leaving Lehman Brothers with cardboard boxes after the investment bank filed for bankruptcy. It marks a genuine turning point, but it begins the story when the machinery became visible, not when that machinery was built. Lehman did not create the mortgages already failing across the United States, or the securities carrying those losses through banks in New York, insurers in London, and investment funds around the world. The deeper question is how a decline in American house prices became capable of threatening the global supply of credit. To answer it, we have to leave September 2008 behind and follow one ordinary mortgage through a financial system that had quietly learned to treat debt as money. The journey began far from Wall Street and suburban developments, mortgage offices, appraisal firms, and kitchen table conversations about monthly payments. Traditionally, a bank that made a 30-year mortgage expected to collect the payments and bear the consequences if the borrower failed. That imposed a simple discipline: the institution approving the loan remained exposed to its quality. By the early 2000s, that relationship had changed. A broker could earn a fee when a loan closed. An originator could sell it. An aggregator could collect thousands of mortgages. A securities firm could package them for investors. The person deciding whether the borrower could repay might never hold the risk long enough to discover the answer. Credit had become a production line, and every completed loan supplied material for the next stage. At the center of that production line was securitization. Thousands of mortgage payments were pooled inside a legal structure, and claims on those payments were sold as mortgage-backed securities. The pool was divided into layers called tranches. Investors in the senior layer were paid first and were protected by losses absorbed below them. Lower layers offered higher returns but stood closer to the first defaults. On paper, this created a ladder of risk suited to different buyers. A pension fund could purchase a highly rated senior bond. A hedge fund could take a riskier slice. The structure did not eliminate the danger inside the mortgages. It rearranged the order in which investors would feel it. Yet while home prices rose and defaults stayed low, rearrangement looked remarkably similar to disappearance. The scale of the transformation was extraordinary. Wall Street issuance of private label securities backed by subprime mortgages rose from about $87 billion in 2001 to roughly $465 billion in 2005. Securities backed by Alt-A loans, often issued with limited documentation or other unconventional features, rose from about $11 billion to more than $330 billion over the same period. These were no longer experiments at the edge of banking. Every new security created demand for more loans. Every demand for more loans created pressure on brokers and lenders to find more borrowers. The system no longer merely financed houses. It required a continuing supply of mortgages to keep factories of fees, ratings, trading income bonuses, and investor returns operating. Then Wall Street discovered that even the lower-rated pieces could be transformed again. Securities firms and specialized managers placed tranches from many mortgage bonds inside collateralized debt obligations, or CDOs. These structures created another waterfall of payments and another set of ratings. Between 2003 and 2007, national house prices rose about 27%. Roughly $4 trillion in mortgage-backed securities were created, and Wall Street issued nearly $700 billion in CDOs containing mortgage securities. CDOs became major buyers of the riskier pieces that ordinary investors were less willing to hold. That demand supported their prices, which supported more mortgage bonds, which supported more mortgage origination. The machine had learned to purchase its own exhaust. Credit rating agencies gave this machine its language of safety. Many institutional investors were restricted from buying assets below certain ratings. A AAA label could therefore turn an unfamiliar security into something that appeared comparable to the safest corporate or government debt. The agencies were paid by the firms issuing the securities, creating an obvious conflict without proving that every rating was dishonest. The deeper weakness was methodological. Their models relied heavily on a period in which nationwide home prices had rarely fallen together. Diversification appeared to protect a pool because defaults in one region were expected to be offset elsewhere. But when standards weakened across the country and similar assumptions shaped thousands of deals, the supposed diversity was often the same risk wearing different postal codes. Another layer promised protection if those ratings failed. Through credit default swaps, an institution could pay another party to compensate it if a bond suffered a credit event. Used carefully, this resembled insurance. Used widely, it created a web of promises among firms that did not always know the full condition of everyone standing behind them. AIG Financial Products became an important seller of protection on highly rated structured securities. Because the bonds were considered remote from default, the contracts appeared to generate fees with limited danger. But the protection did not remove the system's losses. It transferred them to a counterparty required to perform precisely when markets were under maximum stress. What looked like dispersed risk could become concentrated obligation. The securities also acquired a second life as collateral. Investment banks financed inventories of bonds through repurchase agreements known as repo. One party sold a security for cash and promised to buy it back shortly afterward, often the next day. Economically, it was a collateralized loan. When lenders trusted the collateral, they provided large amounts of cash and demanded only a small margin of safety. A dealer did not need $1 of permanent capital for every dollar of securities it held. It could borrow most of the money, renew the loan repeatedly, and earn the difference between financing costs and bond returns. The danger was equally simple. A 30-year mortgage asset was being supported by funding that could disappear overnight. This was banking without the familiar appearance of a bank. Traditional banks financed loans partly with insured deposits and could borrow from the Federal Reserve under established rules. The expanding shadow banking system relied on repo, commercial paper money market funds, securities lending, and off-balance sheet vehicles. Its lenders were corporations, pension funds, investment funds, and other pools of cash seeking a safe place to store money while earning a return. Mortgage bonds functioned as money-like collateral inside this world. But there was no equivalent of deposit insurance covering every repo lender or money market investor, and no complete emergency framework for rescuing every broker-dealer or structured vehicle. The system performed the work of banking while avoiding many of banking's protections and public visibility. The demand was global. American households supplied the mortgage payments, but the securities traveled through institutions around the world. Foreign banks, especially in Europe, bought dollar-denominated mortgage assets and often funded them by borrowing dollars in wholesale markets. Pension funds and insurers wanted highly rated bonds offering more return than government securities. Reserve accumulation, abundant global savings, and a worldwide search for yield kept money flowing toward American credit. Ben Bernanke described part of this environment as a global saving glut, while later research stressed the gross borrowing and lending of international banks. This was not simply a story of Americans borrowing from cautious foreign savers. Global banks helped manufacture purchase finance and distribute the securities that made the boom possible. Government institutions were inside this system too, but not in the simple way often claimed afterward. Fannie Mae and Freddie Mac bought and guaranteed enormous volumes of mortgages and also purchased private label securities to earn returns, defend market share, and support housing objectives. Federal policy encouraged home ownership. Low interest rates made borrowing cheaper, yet much of the aggressive expansion in weakly documented and high-risk lending came through private mortgage companies and Wall Street securitization. Some critics would blame government housing mandates, others would blame deregulation and private incentives. Still others would emphasize global capital flows and monetary policy. Each explanation identified part of the structure. None alone explained why standards weakened investors accepted the bonds' ratings remained generous, and long-term risk was financed with money that could flee immediately. Regulation followed legal categories while finance crossed between them. Commercial banks, thrifts, broker-dealers, insurers, government-sponsored enterprises, mortgage brokers, rating agencies, derivatives. Dealers and off-balance sheet vehicles answered to different supervisors. Some important activities sat between mandates. The Securities and Exchange Commission created voluntary consolidated supervision for the largest investment bank groups, but it lacked the same statutory framework used for bank holding companies. Banking regulators could examine institutions they supervised, yet risk could move into securities conduits or affiliates outside familiar capital rules. Derivatives expanded with limited transparency. The problem was not the total absence of regulation. It was a fragmented perimeter around a system skilled at moving assets, liabilities, and risk toward the most advantageous treatment. For families inside the boom, the machinery produced benefits before it produced ruin. Rising property values allowed owners to refinance, extract equity, pay debts, remodel homes, or support consumption. Construction created jobs. Local governments collected more revenue. Brokers and lenders earned commissions. A borrower offered an adjustable rate mortgage might focus on the affordable introductory payment and assume refinancing would remain available. The broker might focus on closing the loan. The originator might focus on selling it. The securitizer might focus on completing the pool. The rating analyst might focus on whether the structure met the model. No participant needed to believe the entire system was safe. Each needed only to complete one transaction while rising home prices concealed the weakness passed to the next institution. By 2006, the concealment was ending. Home price growth slowed, then reversed in many markets. Borrowers who expected to refinance discovered that falling property values closed the exit. Delinquencies increased especially among recent loans with weak documentations, high leverage, or payment resets. Mortgage lenders began failing. Securities backed by those loans were downgraded, but downgrades created another problem. No one knew where the losses had landed. They might be inside a bank, a CDO, an insurer, a hedge fund, a money market vehicle, or a European institution financed in dollars. Because the same securities were used as collateral, doubts about credit quality became doubts about funding. Falling prices forced institutions to post more collateral or sell assets, and those sales pushed prices lower. A housing correction was becoming a financial feedback loop. On August 9, 2007, the French bank BNP Paribas suspended redemptions from 3 investment funds exposed to asset-backed securities, explaining that parts of the market had become too illiquid to value reliably. The funds were not enormous compared with the global banking system. That made the signal more disturbing. If highly rated securities could not be priced, lenders could not know how much cash to advance against them. If lenders withheld cash, institutions holding those securities would have to sell. If everyone tried to sell into the same doubtful market, prices would collapse further. The visible crisis of 2008 was still more than a year away. But the machine that had turned mortgages into bonds, bonds into collateral, and collateral into money, had encountered the question it was never designed to answer: what happens when the money is no longer trusted. Once mortgage securities could no longer be trusted, the problem was not merely that banks owned bad assets. The deeper problem was that those assets were supporting loans that had to be renewed constantly. A lender in the repo market did not need to prove that a bond would ultimately default. It needed only to doubt what the bond could be sold for tomorrow. That doubt changed the terms immediately. Lenders demanded more collateral, shortened maturities, or withdrew altogether. Institutions responded by selling securities to raise cash, pushing prices lower, and making the remaining collateral appear even weaker. Losses produced funding pressure. Funding pressure produced forced sales. Forced sales produced larger losses. The modern bank run had begun, but instead of frightened families lining up outside marble branches, it appeared as silent refusals on trading screens. The first dramatic warning came from funds and mortgage companies, but by early 2008, the panic had reached Bear Stearns. The investment bank held hundreds of billions of dollars in assets and depended heavily on short-term financing. Its reported capital could not protect it if counterparties refused to lend against its securities. In March, rumors about Bear's condition accelerated withdrawals of cash and collateral. Within days, the firm warned that it could not meet its obligations without emergency support. The Federal Reserve helped arrange its acquisition by J.P. Morgan Chase and financed a portfolio of difficult assets to make the transaction possible. Officials argued that Bear's disorderly failure could damage payment derivatives and funding networks. They were not rescuing an isolated office tower. They were protecting the promises connecting it to the rest of the market. The Bear intervention revealed both the power and the weakness of the government's position. The Federal Reserve created a facility allowing primary dealers institutions that traded government securities directly with the central bank to borrow against collateral. It was a major extension of emergency support beyond the traditional commercial banking system. Yet the rescue also created a political problem. If Bear's creditors could escape a chaotic bankruptcy, would every large financial firm expect similar protection? Officials feared moral hazard, the belief that institutions would take greater risks if the government absorbed the consequences. Members of Congress and the public saw executives, traders, and investors receiving assistance unavailable to homeowners facing foreclosure. A policy presented as protection for the wider economy looked from outside the financial system like protection for the people who had designed its most dangerous products. There was still time to reduce the danger, but not much was done to change the structure that made Bear vulnerable. Investment banks attempted to raise capital and reduce exposures, while regulators demanded more information and encouraged private solutions. Yet mortgage prices continued falling, and institutions were reluctant to sell assets at levels that would reveal larger losses. The months after Bear might have been used to build a clear system for resolving a failing broker-dealer, impose consistent liquidity requirements, or recapitalize weak firms before panic returned. No complete framework emerged. The United States had deposit insurance and procedures for closing ordinary banks, but it lacked an equivalent process for dismantling a global investment bank whose derivatives and financing contracts crossed thousands of counterparties. The government had prevented one collapse without solving the problem revealed by it. By the summer of 2008, the crisis had reached Fannie Mae and Freddie Mac. Together, the two government-sponsored enterprises stood behind or financed more than $5 trillion in mortgages and mortgage securities. Their importance made the question of support unavoidable. If investors lost confidence in their debt, mortgage rates could rise, housing credit could contract further, and institutions around the world could suffer losses on securities assumed to carry an implicit government guarantee. In early September, the Federal Housing Finance Agency placed both enterprises into conservatorship, while the Treasury established financial support intended to keep them operating. The government had now protected Bear, opened emergency lending to securities dealers, and placed the central institutions of American housing finance under federal control. But markets still did not know where the boundary of rescue would be drawn. The answer appeared to arrive 1 week later. Lehman Brothers had survived the first phase of the panic, but its exposure to real estate dependence on short-term funding and declining market confidence made survival increasingly difficult. During the weekend of September 13th and 14th, government officials and leading bank executives searched for a private buyer. Bank of America turned toward Merrill Lynch. Barclays considered acquiring Lehman but could not complete a transaction under the available conditions. Officials later argued that the Federal Reserve lacked sufficient collateral to justify a loan large enough to save the firm. Critics responded that authorities had been creative when rescuing Bear and would soon become even more creative elsewhere. The legal and financial possibilities remain disputed. What is not disputed is that no rescue was assembled. On September 15th, Lehman Brothers filed for bankruptcy. The public saw employees carrying boxes into the streets. Financial institutions saw something more frightening: a map of obligations that could no longer be treated as certain. Money owed by Lehman was frozen inside bankruptcy. Derivatives contracts had to be valued, closed, transferred, or replaced. Hedge funds that had used Lehman as a prime broker worried about access to their assets. Trading partners questioned whether other investment banks might be next. Lenders became more cautious not only about mortgage bonds, but about the institutions holding them. The bankruptcy did not create the underlying losses, and the run had already begun. But it destroyed the remaining assumption that a major interconnected institution would necessarily be protected before it failed. The decision was intended partly to demonstrate that government support was not automatic. Instead, it made the treatment of every large institution uncertain. A creditor could no longer infer from Bear's rescue that Lehman would be rescued. After Lehman, it could not infer that the next firm would be allowed to fail. Uncertainty about policy became another form of financial risk. A rational lender did not need to wait for regulators to make the next decision. It could withdraw first. This is why the crisis cannot be explained by insolvency alone. Some firms had suffered losses severe enough to threaten their capital. Others were endangered because no one wanted to provide funding, while the value of their assets and the government's response remained unclear. In a run, fear of future illiquidity can create illiquidity in the present. The next institution was AIG, one of the world's largest insurance organizations. Its traditional insurance businesses were not the immediate center of the crisis. The danger came largely through its financial products operation, which had written credit default swap protection on enormous portfolios of mortgage-related securities and other financial exposures. As the securities were downgraded and market values fell, AIG faced demands to post additional collateral. The company could not raise enough cash quickly without selling assets into distressed markets. Because major banks had purchased protection from AIG, its failure threatened to replace one source of uncertainty with many new losses across the system. On September 16th, the Federal Reserve authorized an emergency credit line of up to $85 billion. The contrast with Lehman was immediate and politically explosive. One institution had entered bankruptcy on Monday, another received emergency support on Tuesday. Officials argued that AIG possessed assets that could secure a loan, and that its sudden failure would produce unacceptable damage across insurance securities, lending derivatives, and banking networks. That reasoning was defensible, but it did not make the intervention neutral. Supporting AIG also protected institutions that had relied on its promises. The public justification was systemic stability. The practical effect included preserving specific counterparties from losses they might otherwise have absorbed. This did not prove a secret plan to favor certain banks. It demonstrated a harsher reality once a firm became deeply embedded in the system. Rescuing the system and rescuing its contractual partners became almost impossible to separate. Then the panic reached an institution designed to feel almost as safe as cash. The Reserve Primary Fund, a large money market mutual fund, held short-term debt issued by Lehman Brothers. After Lehman failed, the fund announced that its shares were worth less than the customary $1. It had broken the buck. Investors began withdrawing from prime money market funds, including funds with little or no Lehman exposure. Fund managers needing cash attempted to sell commercial paper and other short-term assets, but buyers were disappearing. A run that had moved through mortgage securities and investment bank funding was now threatening a part of the financial system used by corporations, municipalities, pension accounts, and institutional treasurers as a place to hold liquid money. The commercial paper market connected that panic to the ordinary economy. Large companies use short-term paper to manage working capital finance inventories, support consumer credit, and meet operating needs. They did not all depend on it in exactly the same way, and payrolls were not universally financed by issuing paper each morning. But when investors stopped buying, even healthy businesses had to preserve cash draw on bank credit lines, delay investment, reduce inventories, or reconsider hiring. Banks already protecting their own balance sheets faced additional demands from corporate clients. A worker in a factory or an employee at a dealership did not need to own a mortgage bond to be affected. Once short-term credit stopped circulating, the financial crisis began determining whether real businesses could obtain the money required to operate. The fear also entered traditional banking. Washington Mutual had expanded aggressively during the housing boom and suffered mounting mortgage losses as property prices fell. Depositors withdrew funds at extraordinary speed, assisted by electronic transfers that made a modern run faster and less visible than the queues of the 1930s. On September 25th, regulators closed the bank. With about $307 billion in assets, it became the largest bank failure in American history by the standard FDIC measure. J.P. Morgan Chase acquired its banking operations and assumed its deposits. Depositors remained protected, but shareholders and some creditors were not. The resolution proved that the government could close a large deposit-taking bank without freezing its customers' money. It also highlighted how much more difficult Lehman had been. The investment bank existed outside that established resolution system. Historians and economists would later disagree about which failure mattered most. The majority report of the Financial Crisis Inquiry Commission emphasized reckless lending, excessive leverage failures of regulation, poor corporate governance rating errors, and a lack of preparation for systemic risk. One dissent emphasized a broad international credit bubble and the panic that followed its collapse. Another placed far greater weight on government housing policy and the accumulation of risky mortgages. Gary Gorton and Andrew Metrick described the central mechanism as a run on repo and securitized banking. Each interpretation explained something important. Mortgage deterioration supplied the losses. Leverage magnified them. Short-term funding transformed uncertainty into immediate failure. Policy inconsistency intensified fear. No single institution caused the panic, but the system connected their weaknesses so tightly that the failure of one changed the perceived safety of all the others. By late September, Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke asked Congress for authority to purchase troubled assets from financial institutions. The proposed scale was $700 billion. To supporters, the plan was an emergency attempt to restore prices and lending before the panic destroyed more banks and businesses. To opponents, it was an extraordinary transfer of risk from private finance to the public after years of profits had remained private. On September 29th, the House of Representatives rejected the first version, and markets fell sharply. Negotiations continued as credit conditions worsened. On October 3rd, Congress approved the Emergency Economic Stabilization Act and created the Troubled Asset Relief Program. The government now possessed immense authority, but the central moral problem remained unresolved. Saving finance might be necessary to protect society, yet saving finance would not guarantee that society recovered with it. The rescue began with a quiet admission. The original plan was too slow for the crisis unfolding in real time. Congress had authorized the Treasury to purchase troubled assets from financial institutions, hoping that government demand would establish prices and remove uncertainty from bank balance sheets. But deciding which securities to buy, how to value them, and how much taxpayers should pay could take months. The system was deteriorating by the day. Treasury officials therefore changed direction. Rather than begin by buying the mortgage securities poisoning the market, the government would inject capital directly into financial institutions. The state was no longer attempting merely to clear damaged assets from the machine. It was becoming a temporary shareholder in the institutions operating it. On October 14, 2008, the Treasury announced that it would make as much as $250 billion available through the Capital Purchase Program. 9 major financial organizations agreed to receive a combined $125 billion. Some of them might have survived without the money which was part of the design. Officials feared that injecting capital only into visibly weak banks would mark them for further runs. By placing public funds into stronger and weaker institutions together, the government hoped to make participation appear like a system-wide defense rather than a confession of insolvency. The Treasury received preferred shares and other financial claims in return. The transaction was presented as an investment, but its immediate purpose was psychological. The government wanted creditors to believe that the largest banks would have enough capital to absorb further losses. Capital alone could not repair markets in which private lenders had stopped functioning. The Federal Reserve, therefore, became a lender of last resort, not only to banks but to parts of the financial system that earlier generations of central bankers had barely imagined. It supported money market funds after investors rushed to withdraw. It financed a facility that purchased newly issued commercial paper when corporations could not obtain normal short-term funding. It lent against securities that private markets no longer trusted. It had already opened emergency credit to primary dealers, and its balance sheet now expanded as private balance sheets contracted. The central bank was replacing markets that had not merely become expensive, but had ceased to perform their basic function of turning acceptable collateral into usable cash. The crisis also revealed that the dollar system extended far beyond the borders of the United States. European and other international banks had accumulated dollar assets while relying on short-term dollar borrowing to finance them. When private dollar funding disappeared, their own central banks could create euros, pounds, francs, or yen, but not the currency required to meet dollar obligations. The Federal Reserve responded through temporary swap arrangements with 14 foreign central banks. At their peak in December 2008, these swap lines supplied hundreds of billions of dollars to the international system. The rescue was therefore not simply American money protecting American banks. It was an acknowledgement that the Federal Reserve had become the emergency supplier of the currency on which global finance depended. Officials defended these measures by arguing that the alternative was not a morally pure bankruptcy process. It was a chain reaction. If a major bank stopped paying, its counterparties could suffer losses. If those counterparties could not raise cash, they might sell assets or default on their own obligations. Money market funds could withdraw from commercial paper. Corporations could lose access to working capital. Banks could stop lending to households and businesses. The logic was systemic, and much of it was persuasive. Yet the rescue could not avoid protecting specific creditors, investors, and institutions. The government had allowed markets to build a network so interconnected that preserving the network meant supporting many of the firms inside it. Too big to fail was not simply a description of size, it was a description of dependence. While emergency programs stabilized finance, the economy continued falling. The recession that had begun in December 2007 lasted 18 months. From its peak to its trough, real gross domestic product declined by more than 4%, making it the deepest American contraction since the Second World War at that time. Unemployment rose from 5% at the recession's beginning to 10% in October 2009. The official recession ended in June, months before joblessness reached its peak. That difference mattered. Financial markets could improve while families were still losing wages, insurance, homes, and savings. The system could be described as recovering even when millions of people experienced no recovery at all. The most destructive transmission mechanism ran through household balance sheets. During the boom, rising home values had allowed families to borrow, refinance, and spend. When prices collapsed, the process moved in reverse. A household owing nearly as much as a home was worth could not easily move, refinance, or absorb an income shock. A household owing more than the property's value faced an even narrower set of choices. Foreclosures placed additional homes on the market, weakening prices in surrounding communities. Families trying to reduce debt cut consumption. Local businesses lost customers. Employers reduced hours or dismissed workers. Falling employment then created more mortgage distress. Research by Atif Mian and Amir Sufi would emphasize this cycle. Heavily indebted communities reduced spending, most sharply turning a housing crash into a broad collapse in demand. The government's tools for rescuing households were weaker, slower, and more complicated than its tools for rescuing financial markets. A central bank could lend to an institution against collateral in a single transaction. Modifying millions of individual mortgages required negotiations among borrowers, servicers, investors, trustees, and institutions holding different claims on the same loan. The Making Home Affordable initiative and its principal modification program sought to reduce payments and prevent avoidable foreclosures. It eventually assisted many homeowners, but it did not reach everyone in danger, and implementation exposed how poorly mortgage servicing systems had been designed for mass modification. The machinery built to collect payments and process defaults could not easily become a system for rewriting loans one household at a time. This unequal speed shaped the political meaning of the crisis. Banks could argue that public support was temporary and that many investments would be repaid. That was true. The $700 billion TARP authorization was never the same as $700 billion permanently lost. Congress later reduced the available authority. Treasury disbursed far less than the original ceiling, and much of the money invested in banks, AIG, the automobile industry, and credit programs was eventually recovered. But measuring the bailout only through Treasury's final cash return misses the larger price. It does not count lost employment, abandoned homes, reduced output, damaged health, foregone education, closed businesses, or the years required for household wealth to recover. A rescue can earn money on its financial claims while the crisis that required it remains enormously costly. By early 2009, another problem threatened the recovery. Investors still did not know which large banks were strong enough to survive a deeper recession. Rumors filled the information vacuum. The government answered with the Supervisory Capital Assessment Program, the first coordinated stress test of the 19 largest American bank holding companies. Regulators estimated losses under an adverse economic scenario and publicly identified the capital buffers institutions would need. 10 of the 19 were required to raise a combined total of roughly $75 billion. Publishing weaknesses appeared dangerous, but secrecy had become more dangerous. The test placed a credible public estimate where markets had imagined unlimited losses. Banks raised capital, converted preferred shares, retained earnings, and gradually repaid government investments. Confidence began to return because uncertainty had been reduced. Stability did not restore the financial landscape that existed before the panic. Bear Stearns and Washington Mutual had disappeared into J.P. Morgan Chase. Merrill Lynch had entered Bank of America. Wachovia had been acquired by Wells Fargo. Other institutions failed, merged, or retreated from businesses they had once dominated. The government had prevented uncontrolled collapse partly by encouraging stronger firms to absorb weaker ones. That made the surviving system more concentrated. Institutions already considered systemically important emerged with larger balance sheets, more customers, and broader market positions. The crisis demonstrated the danger of allowing firms to become indispensable. Yet some of the immediate solutions made the largest firms even more central to the system. This is where the major interpretations of the crisis meet. The Financial Crisis Inquiry Commission. Majority argued that the disaster was avoidable and emphasized regulatory failure, corporate mismanagement, excessive borrowing, weak mortgage standards, rating failures, and a lack of accountability. Gary Gorton's bank-run interpretation explains why uncertainty about collateral produced a sudden withdrawal of short-term funding. Mian and Sufi explain why household debt transformed the financial shock into a deep and uneven recession. Ben Bernanke emphasizes the panic and the need to restore lender of last resort functions. Adam Tooze draws attention to European banks' global dollar dependence and international central bank cooperation. Raghuram Rajan places the disaster within wider political and economic fault lines. These are not mutually exclusive stories. They describe different stages of the same collapse. Housing supplied the vulnerable loans. Securitization carried them into global portfolios. Ratings made them appear safe. Derivatives connected institutions that believed risk had been transferred. Leverage multiplied the losses. Short-term wholesale funding made those losses immediately dangerous. Fragmented regulation allowed risk to migrate beyond traditional banking safeguards. Global dollar finance carried the panic across borders. Household debt converted falling asset prices into reduced consumption and unemployment. Government decisions during the panic determined which failures were contained and which were allowed to transmit fear. The argument over the single cause is therefore misleading. The crisis became catastrophic because several mechanisms that appeared separate during the boom turned out to be parts of one financial system. The legislative response attempted to place barriers around that system. The Dodd-Frank Act created a council responsible for monitoring systemic threats. Increased oversight of large financial companies, expanded the regulation and clearing of derivatives, established new consumer protections, required large institutions to prepare plans for their own failure, and created an orderly liquidation authority for financial companies whose collapse could threaten stability. Capital and liquidity requirements were strengthened through domestic and international reforms. Stress testing became a regular feature of supervision. These changes made important parts of the banking system more resilient. But no law could permanently eliminate financial innovation, political pressure, regulatory gaps, or the incentive to move risk toward institutions where restrictions appeared lighter. Return finally to the employees carrying boxes from Lehman Brothers. They were not witnessing the moment when a few bad mortgages suddenly destroyed a healthy economy. They were standing at the point where an invisible run became impossible to ignore. The system had taken long-term mortgage debt, divided it into securities, rated it as safe, insured it through derivatives, pledged it as collateral, and financed it with money that could vanish overnight. When trust disappeared, governments were forced to choose between rescuing institutions they had failed to restrain and allowing those institutions to pull the wider economy into collapse. The familiar story tells us that Lehman failed. The deeper story is that finance had quietly rebuilt banking without admitting how much it still depended on the oldest promise in banking, that everyone would not demand their money at once. The rescue prevented a worse disaster, but prevention was not the same as justice, and financial recovery was not the same as social recovery. That is the real price of the 2008 crisis. If you found this deeper history useful, subscribe to the Price of History docs and like the video. And tell us in the comments which mattered most, the housing bubble, Wall Street, leverage, shadow banking, regulatory failure, or the decisions made during the panic.